Welcome back to our channel. Today, we're diving into an essential topic for any investor looking to build a solid portfolio: growth stocks versus dividend stocks. These two investment strategies can offer different benefits depending on your financial goals, risk tolerance, and investment horizon. By the end of this video, you'll have a clear understanding of what each type of stock entails, their pros and cons, and which might be the right choice for you. Remember, this is not financial advice. What are growth stocks? Growth stocks are shares in companies that are expected to grow at an above-average rate compared to other companies in the market. These companies often reinvest their earnings back into the business to fuel further growth, rather than paying out dividends to shareholders. Think of tech giants like Amazon, Google, or Tesla, companies that focus on expanding their market share, developing new products, and entering new markets. Characteristics of growth stocks. 1. High revenue and earnings growth. These companies typically report higher than average revenue and earnings growth rates. 2. Reinvestment of profits. Instead of paying dividends, growth companies reinvest profits to foster further expansion. 3. High price-to-earnings ratios, P/E ratios. Growth stocks often trade at higher P/E ratios due to their expected future earnings growth. 4. Volatility. They can be more volatile than the overall market, with significant price swings possible. 5. Innovation and market disruption. Often found in sectors like technology, biotechnology, and other industries where innovation drives growth. What are dividend stocks? Dividend stocks, on the other hand, are shares in companies that return a portion of their earnings to shareholders in the form of dividends. These companies are usually well established, with stable earnings and a history of paying out dividends regularly. Companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble are classic examples of dividend-paying stocks. Characteristics of dividend stocks. 1. Regular income. Dividend stocks provide regular income through dividend payments, which can be especially appealing for retirees or those seeking passive income. 2. Stability and lower volatility. These stocks are generally less volatile and can provide a cushion during market downturns. 3. Lower growth rates. While they offer income, dividend-paying companies often have slower growth rates compared to growth stocks. 4. Dividend yield. Investors often look at the dividend yield, which is the annual dividend payment divided by the stock's current price. 5. Financial health and consistency. These companies often have strong balance sheets and consistent earnings, which support their ability to pay dividends. Before we continue, remember to like the video and subscribe to the channel. Pros and cons of growth stocks. Pros. 1. Potential for high returns. Growth stocks can offer significant capital appreciation over time. 2. Innovation and market leadership. Investing in companies at the forefront of innovation can be exciting and rewarding. 3. Reinvestment leads to compound growth. Profits are reinvested into the business, potentially leading to exponential growth. Cons. 1. High volatility. Prices can be more volatile, leading to potential for significant losses. 2. No dividend income. Investors do not receive regular income, which might be a drawback for those seeking steady cash flow. 3. Overvaluation risk. High expectations can lead to overvaluation, and if growth doesn't materialize, stock prices can plummet. Pros and cons of dividend stocks. Pros. 1. Steady income stream. Dividends provide regular income, which can be reinvested or used for expenses. 2. Lower volatility. Generally, dividend stocks are less volatile, offering stability in uncertain markets. 3. Potential for total return. Even with slower growth, dividends contribute to total return over time. Cons. 1. Slower growth potential. Dividend-paying companies often have slower growth rates. 2. Dividend cuts. Companies can reduce or eliminate dividends, impacting income. 3. Tax implications. Dividend income is taxable, which can affect net returns. Which should you choose? Deciding between growth stocks and dividend stocks depends on your individual financial goals, risk tolerance, and investment strategy. Choose growth stocks if 1. You have a long investment horizon. Younger investors with decades to invest might prefer growth stocks for their potential for high returns. 2. You can tolerate higher risk. If you're comfortable with market volatility and the potential for significant price swings, growth stocks might be suitable. 3. You're focused on capital appreciation. Investors looking for substantial growth in their investment value might lean towards growth stocks. Choose dividend stocks if 1. You need regular income. Investors who require regular income, such as retirees, may prefer dividend stocks. 2. You prefer stability. Those who want less volatility and more stable returns might opt for dividend stocks. 3. You're interested in total return. Investors who appreciate both income and potential for appreciation through reinvested dividends might find dividend stocks appealing. Building a balanced portfolio. Many investors choose to combine both growth and dividend stocks in their portfolios to balance risk and reward. This approach can provide the potential for high returns while also offering some stability and income. Balanced portfolio strategy. 1. Diversification. Spread investments across various sectors and industries to mitigate risk. 2. Rebalancing. Regularly review and adjust your portfolio to maintain your desired allocation between growth and dividend stocks. 3. Dividend reinvestment. Reinvest dividends to take advantage of compound growth. 4. Monitoring. Keep an eye on market trends, company performance, and economic indicators to make informed decisions. Let's look at a couple of examples to illustrate the differences between growth and dividend stocks. Example of a growth stock. Tesla, TSLA. Tesla is a prime example of a growth stock. Over the past decade, Tesla has focused on expanding its market share in the electric vehicle industry, investing heavily in research and development, and scaling its production capabilities. This strategy has resulted in significant revenue and earnings growth, with its stock price reflecting this upward trajectory. However, Tesla's stock is also known for its volatility, experiencing substantial price swings based on news, market conditions, and investor sentiment. Example of a dividend stock. Coca-Cola, Co. Coca-Cola is a classic example of a dividend stock. The company has a long history of paying consistent dividends to its shareholders. Coca-Cola operates in a stable industry with predictable earnings, allowing it to return a portion of its profits to investors regularly. While the stock may not offer the explosive growth potential of a company like Tesla, it provides steady income and lower volatility, making it a popular choice for income-focused investors. In summary, both growth stocks and dividend stocks have their unique advantages and potential drawbacks. Growth stocks can offer high returns through capital appreciation but come with higher risk and volatility. Dividend stocks provide regular income and stability but might have slower growth rates. When deciding which to invest in, consider your financial goals, risk tolerance, and investment horizon. For many investors, a balanced portfolio that includes both growth and dividend stocks can provide the best of both worlds, offering the potential for high returns while also providing some income and stability. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell so you don't miss any of our future videos. Let us know in the comments which type of stock you prefer and why. Happy investing, and see you next time.